Understand these 5 realities before investing in an IPO. The clock is striking 11 at night and a middle-class investor is looking at his phone screen. The same news is playing everywhere. A new IPO is coming, a listing gain could be made, the opportunity might slip away. People are sending screenshots in his WhatsApp groups. Someone is sharing the GMP, someone is saying that this share will run on the very first day, and someone else is saying that if you don't apply, you will regret it. His hand moves forward to approve the UPI mandate, but just then, a small fear arises in his mind. Is he really making an investment, or is he running behind the crowd? The curiosity begins right here. Because from the outside, an IPO looks like an opportunity, but from the inside, it is a test of the company, of the market, and of the investor's understanding. As soon as momentum returns to the stock market, the buzz in the IPO market increases again. New companies come into the public market, advertisements are seen, subscription numbers flash, and the excitement of retail investors suddenly shoots up. But every IPO is not a path to wealth creation. Some IPOs bring a genuinely strong business, while others come to raise money at an expensive valuation just by taking advantage of the market mood. It is important to understand that an IPO does not just mean buying a share for the first time. It means you are putting your money into the public journey of a private company. When a company brings an IPO, it either raises money for the business through a fresh issue, or existing investors sell their shares in an offer for sale. If the money is going into the company's growth, debt reduction, or expansion, then the story can be different. But if a major portion is going toward the exit of old investors, then the investor needs to be more cautious. First of all, it is essential to check the financial position of the company. Just because the revenue is large does not make the business strong. The real question is whether profit is being made or not. Many companies increase their sales rapidly, but along with that, their losses also keep increasing. In such a scenario, growth may look attractive, but the cash flow can be weak. The DRHP and RHP state the revenue, profit, debt, margins, and cash flow of the previous years. These very documents show the investor the real picture behind the glossy advertisement. A smart investor first looks at how the company is actually earning money, whether its business model is simple or just decorated with complicated words. If the company is increasing its revenue every year, the profit margin is stable, and the debt is under control, then its foundation can be considered strong. But if the company is continuously burning cash despite growing revenue, the loan is increasing, and the profit rests on future promises, then caution is necessary. Many times in an IPO story, it is said that the market opportunity is very large. But a large market alone does not give returns. One has to look at the company's actual position in that market. The investor should also look at what the company is doing differently from its competitors. Does it possess a brand, technology, distribution, pricing power, or loyal customers? Financial numbers are not read just with a calculator. They have to be understood like a story, because every number hides some habit of the business. The second big aspect is the promoter and the management. After all, who are the people running the company, how is their track record, and how have they taken decisions during difficult times? A strong promoter is not just a big name. A strong promoter is one who runs the business with discipline, respects minority shareholders, and is transparent in governance. If regulatory issues, related party transactions, or corporate governance concerns are seen repeatedly with the promoters, the investor should pause before getting excited. The quality of management does not appear directly on the balance sheet, but its impact on long-term returns is very deep. A bad management can weaken even a good company. The investor should also see how much holding the promoters retain after the IPO. If the promoters are selling too much stake, the question arises as to how confident they themselves are. Not every offer for sale is bad, because early investors might need an exit. But if the whole story feels like it is just about an exit, then there is a need to think. The company's independent directors, auditors, and key managerial persons are also important. Because in the public market, trust is built not just by the product, but by governance. The third thing is the company's strengths and risks. Risk factors are written in every IPO prospectus, but most retail investors skip them. This is where the biggest mistake happens. Risk factors look boring, but that very section tells you what can break the business. The strength of a company can be its market share, manufacturing capacity, brand recall, distribution network, or customer base. But the weaknesses must be read with equal attention. If the company's earnings depend only on a few large customers, then losing a single customer can shake the numbers. This risk is very important. If raw material prices are volatile, import dependence is high, or changing regulations can affect the business, then the return story can weaken. A SWOT analysis is not just an MBA term. It simply means where is the company strong, where is it weak, where is the opportunity, and where is the threat. Suppose a company's product is good, but its distribution is small. This means there is an opportunity, but there is also an execution risk for growth. On the other hand, if the company's network is strong and there are repeat customers, then it might have a better capacity to stand firm against competition. The investor should also see whether the industry the company is in is cyclical or has a stable demand. The risk of every sector is different. Some businesses get affected quickly during an economic slowdown, like luxury demand or discretionary spending. At the same time, some businesses are linked to daily needs where demand can remain relatively stable. The fourth important factor in an IPO is the valuation. Because even a good company can become a bad investment if it is bought at a very expensive price. Valuation means how reasonable the price of the company is compared to its earnings, sales, assets, and future growth. If the company is in profit, the PE ratio can be compared. If there is no profit, then the price to sales, margins, and future profitability have to be looked at carefully. But valuation is not decided by just one ratio. It has to be viewed along with industry peers, growth rate, debt levels, and business quality. In many IPOs, the excitement builds up so much that people do not even worry about the price. They feel that they will get a listing gain and they will exit. This exact thinking can be dangerous, because the market does not always behave according to your exit plan. Demand can suddenly change on listing day. If the IPO is overvalued, the listing can be weak despite good subscription. And if the valuation is fair, a long-term investor can get a better opportunity. Many people also consider the grey market premium as a shortcut. But GMP is not official data and it can change rapidly. GMP can only be a signal of sentiment, not the final truth. If you made your entire decision just by looking at the GMP, you are putting money on a rumor, not research. A smart investor compares the price band with listed competitors. He sees at what valuation companies in the same industry are trading. If a new company is coming at a more expensive price than already established leaders, it needs very strong growth and execution to justify it. The fifth aspect is the market condition. In a bull market, even weak IPOs can shine, and in a bear market, even good IPOs can make a slow debut. The market mood heavily influences investor psychology. When indices are up, liquidity is strong, and confidence is high, then IPO demand increases. But when global uncertainty, interest rate worries, or a market correction occurs, investors suddenly become selective. The same IPO might receive a lower response. Therefore, an IPO should be viewed not just from the company's perspective, but also from the perspective of the market environment. Timing can influence the returns significantly. In recent years, India's IPO market has been very active, but selectiveness in listing gains has also increased. This means that now, just hype will not work. Retail investors should also understand the subscription numbers correctly. If QIB demand is strong, it can be a good signal, but it is not a guarantee. If there is a frenzy only in the retail or HNI segment and institutional interest is weak, the investor should understand the reason. Getting an allotment is also not a guarantee of profit. Many people apply for an IPO because they feel that getting an allotment itself is a jackpot. But an IPO is not a lottery. It is the beginning of business ownership. Even if a share is allotted, the question remains the same: would I want to hold this company? Another important point is how much money to put into an IPO. Putting all your money into a single IPO is not smart investing, it can be emotional betting. Diversification is the safety belt of a retail investor. If one IPO performs poorly, your entire portfolio should not be shaken. The investor should decide according to his goal whether he is applying for a listing gain or for long-term holding. If the strategy is for a listing gain, then market sentiment, subscription, valuation, and expected listing demand will be important. But if it is long-term, the business quality will be at the very top. Before applying for an IPO, the investor should make a simple checklist. Financials, promoters, risks, valuation, and market mood. Money should not be invested without checking these 5 things. This checklist will not keep you away from every IPO. Rather, it will protect you from the wrong IPO and increase the probability of identifying the right IPO. Many times, the best decision is not to apply but to wait. Shares are available in the market even after listing, and by then the price discovery can be clearer. If the company is good but the IPO is expensive, the investor can wait for a better price later. Patience is also a part of investing. The biggest trap in the IPO market is FOMO. People think that if they don't apply right now, the chance will be gone. But opportunities never end in the market. A popular IPO bought at the wrong price can also damage the portfolio. A new investor should understand that the path to returns in the share market is built through discipline, not excitement. When you read the DRHP, compare competitors, look at the promoter background, and understand the risk factors, you become an investor who stands apart from the crowd. A solid return can be gained in an IPO, but only when your decision is built on solid research, not just on social media noise. Therefore, the next time an IPO comes and excitement is visible all around, pause a little before picking up the phone. Look at the company's earnings, understand the promoter's intent, read the risks, compare the valuation, and identify the market mood. If all these 5 things look strong, only then put in money. If a red flag is seen in 2 or 3 of these places, choose safety over excitement. Because the real question in an IPO is not how much higher the share will go on the first day. The real question is whether your money is going into the right business or just getting lost in the crowd. The investor who understands this difference does not consider an IPO a lottery. He views it like a business decision. And this is where the distance between an ordinary investor and a smart investor begins. One buys hype, the other looks for value. When the next IPO comes before you, ask yourself just one question: if this share does not list tomorrow and gets locked for 5 years, would I still buy it? If the answer is yes, then perhaps you have understood the company. If the answer is no, then perhaps you are just dreaming of a listing gain. And the most expensive mistake in the share market happens when the dream becomes bigger than the research.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.